Hello and welcome to Pro Trader Strategies Market Commentary for Unenjoyment Friday, December the 7th. My name's Eric Wilkinson, and some of you may recognize me as the Wolfman from CNBC, Fox Business, or even the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. Please keep in mind that everything that we talk about in these market commentaries is not a solicitation to buy or sell any of these securities or strategies. At the end of the day, I'm here to teach you some different strategies you can then implement into your portfolios, but please do that in your own way. Also, remember that past performance of any trading system or methodology is not necessarily indicative of future results. All right, having that out of the way, let's get it on with some economic data across the pond. We got German industrial production. It's not one of their headline numbers, one of their major numbers, but I thought it was something that we probably should look at, especially with the data points we've been getting here in the United States and across the pond. And industrial production came in at a negative 0.5%, expected to be a positive 0.3%. Keep in mind, this is something we would expect productivity to start increasing heading into a Christmas season. We're not necessarily seeing that. I wouldn't think that we would be pulling back on production heading into the holidays, but that's what we're seeing over in Germany. Bit of a different case in France. Industrial production came in at 1.2%, expected to be 0.9%. And what is that? Oh, sorry, it's supposed to be unchanged. So big increase there. They also revised last month's number up a little bit. It'll be interesting to see how the revisions go with this industrial production for the French, because of all of the riots and everything else that they're having over in Paris. So we'll see if they get a revision on that. And then here in the United States, or actually one other thing, we have OPEC meetings all day today, so you can keep your eyes out for some of that rhetoric. And then here in the United States, we got our hourly average earnings came in at 0.2%, expected to be 0.3%. And if you remember last month, we came in with a 0.2%, which beat estimates, and that is good. We want to see inflation in wages right now, not necessarily in the commodities and things of that nature, but we would like to see some wage inflation here in order to drive the economy rather than people making this economy move off of credit. We'd rather see that due to expansion in wages. All right, so non-farm payroll employment change came in at 155,000 hires, expected to be almost 200,000, much less than expected there. Last month's number got revised down quite dramatically as well by about 13,000. If you remember, it was 250,000. It came in as a revision of 237,000. Now, if we look over here at the markets, we'll see exactly when that data point was released. Not necessarily in the crude oil, I guess. And then we had the unemployment rate came in at 3.7%, expected to be 3.7%. One thing to note, our unemployment is the lowest level we've seen in a non-wartime era. Now, I don't know if that's necessarily how we are necessarily considered not wartime, because we are still over in the Middle East, and it seems like we're still making operations happen. So, I guess it is what it is. And then we got the University of Michigan consumer sentiment in line with expectations at 97.5. Michigan inflation expectations in line at 2.7%. And then finally, we got natural gas storages coming in at a drawdown of 63 billion cubic feet, right in line with expectations. And finally, Bernard speaking in about an hour. Who is a Fed governor. All right, let's check out the overall markets. We've got crude oil bouncing up and away, up over $2 today. Yesterday came within 8 cents of testing that 40 handle. I think a low was $50.08, and then we kind of bounced up and away as the overall markets really started getting a kick in the pants to the upside yesterday, for the most part, after the daily market commentary. When we were talking, it was really pretty low. We were close to the lows of the day. I think we even extended those lows slightly afterwards, but then late in the day, we got a late day rally. It was huge, just a huge whipsaw back up. And this is exactly what I've talked about time and time again. I think that we're going to see these major gyrations happening. I think it's healthy for the overall economy. I don't think that we're going to see this massive flash crash necessarily, because these support and resistance levels that I've talked about have really held, and coming back to the point of control has been a major magnet. So crude oil up on the day. Let's take a look at gold. Gold, we're seeing it continue its upward trajectory. Up another $7. Doesn't look like we're going to go back down there and test that 12 handle anytime soon, but we could come back down to the point of control, where the point of control is. Either I'm more inclined to believe we're going to come down to this 1225 area as opposed to going up to this 1325 area. So I think that the more likely area for gold is in this mid 1200 range rather than the 1300 range. Threw up Bitcoin here because I think at this point, if you are long Bitcoin, you should completely liquidate and then wait for a bounce. Even if you miss out on this level and you're getting back in at 4,000 or something like that, I think that it would behoove you to step aside from Bitcoin because it does not react the way we would expect to in times of trouble. It seems like it has the same fear or directionality as the overall equities. All right, let's look at the bonds. They're giving back a little bit today after we've seen several days of big rallies in there with the equities acting the way they are. That's kind of lockstep what we would expect, people pulling out of some of the more risky assets and parking their money in some more structured products that aren't going to carry the same risk. So bonds have been rallying as it's been a risk-off type trade. But having said that, gone right back to the point of control, as you can see. So all of these markets are migrating back to their point of controls where, anytime we have these kind of crazy moves and stuff like that, that's where it's going to make it calm down because everybody's long and short there. So nobody's too excitable, really. All right, VIX still up in the 20s, slightly higher today as we are seeing the overall equities start to lose some of their momentum from those data points that we talked about, especially that non-farm payroll number just not coming in as good as we would like to see it. We'd like to see a lot of hiring going into the holiday season, obviously. But the Dow Jones Industrial Average off by just over 300 points as of right now, but near the lows of the day. Same with the NASDAQ, down over 112 points right now on the lows of the day. Should see a little bit of support acting here, but it slowed down the downward momentum when we started hitting those Fibonacci levels. But this is what I was talking about with yesterday. You can see that negative almost all day long, late in the day, just rallied to the upside. Again, with the E-mini S&Ps, reflective of what we're seeing across the equities on the lows of the day. E-mini S&Ps finding support as of right now anyway on the Fibonacci extension here, the 23 Fibonacci extension. So we could easily see this market have these moves, maybe even make it up to the point of control. I don't really see it going past this value area low too much. It might pierce it by a few pennies or dollars or whatnot, but at the end of the day, you can see it's really acted as support. That's where the bulls are going to be defending. I don't know that we'll see that again today, but the overall market staying within this area is what I expect, unless we see something major come out of the talking heads or some economic data or OPEC is going to be something that's going to have to be the catalyst in order to spur equities out of this range, I believe. All right, and still sorry about this array that's going on. It's probably driving me as nuts as you guys, but it is what it is. You can see here, we were trying to make a big move to the upside, but that unenjoyment number, which is what we used to call the unemployment number on the floor, unenjoyment, really threw a wet blanket on this, a cold wet blanket onto this market. And you can see right now we are piercing below that support area. So we may start to see a little bit more of acceleration to the downside if we break too far below that. All right. And then a couple of trades that I've talked about. I did this yesterday, late in the day. I added some long deltas using UPS. I tweeted this out that I basically sold some puts, and I went in there, got a little bit more aggressive than that 16 delta strike that I normally do, but I went in and sold the January 100 puts in there for $1.47. And those 100 puts you can see is well below the 52-week low. I don't think that our economy is really that bad. You know, that unemployment number is making me second guess some things, but the rest of the economic data is coming in pretty good. So I don't think that the overall market should really start slamming down at the end of the day. Point of control is about where I think we should be. You can see UPS has migrated to its own point of control, so I think it'll settle down there. So I'm pretty happy with my short puts in there. The other thing is my Caterpillar Deere pairs trade that I kind of put in there. Remember, I sold some calls in Deere, and then when the market came down, I sold some puts in Caterpillar. Now that was setting up perfectly yesterday. Today we can see Caterpillar making a bit of a drop, but the way I've set this trade up, it is really working out nicely as a pairs trade. So I'm up a little bit more on Deere than I'm losing on Caterpillar with this move. So as designed, it is working out quite nicely. I haven't covered that Deere because I created that strangle. If it gets much lower than that, right now I sold the Deere for $1. It's trading around 30 cents, but because I built this strangle around both of them, I want to hold on to the Deere a little bit longer now. So it's probably going to have to decay a little bit more for me to cover that trade. And that's about it for today. I hope everybody has a great weekend. Check out yesterday's webinar. It was on the long put diagonal, especially for a bearish assumption, and it will work great with the assumption I've had if you are long-term bearish, where I think the market's going to settle down here before we make a big move. That's set up great for the calendars or the diagonals. The diagonal setting up great because we're right in between earnings seasons, in a sense, where there are still some earnings being released, but the major ones are coming up in February, just after the beginning of the year. So we can really start setting up for those earnings right now, which is really important. So we can take advantage of volatility expansion in the back month heading into the earnings, and we can take advantage of this high implied volatility we're seeing right now. So it's a great strategy in the interim when you're trying to figure out directionality, where volatility is going to go, and all of those things. I go lockstep, talk about each one of those aspects to this overall, diagonal strategy. So check it out. Also, give me a thumbs up, thumbs down, like or dislike on this video. If you give me a thumbs down, let me know what it is that I can do to change it. And that's about it. Have a great weekend. And if you can't take that, take it easy.